everybody. Welcome to today's presentation, which is our last presentation of the nonprofit education series for this year on contribution accounting. For today's presentation, we have two presenters. We have Daniel, who's one of our partners in both the assurance and advisory practice, as well as Jonathan, one of our advisory managers. And I would like to welcome both of them as they go through talking about our presentation and agenda for contribution accounting.
And before we start talking about contributions, we really need to understand what a contribution is. And the FASB under section 958 605-20 defines a contribution as an unconditional transfer of cash or other assets, as well as unconditional promises to give to an entity or a reduction, settlement, or cancellation of its liabilities in a voluntary, non-reciprocal transfer by another entity acting other than as an owner. Now that's a mouthful of a definition, and we're going to actually piece apart some of the various key terms in this contribution in the coming slides. But in a simplest form, a contribution is a gift. And those gifts can be of cash, they can be what we call in-kind contributions, things like goods or donated services, or they could be forgivenesses of loans or other liabilities. And in just a moment here, we actually have our first alertness check quite early, but so if you just take a moment to answer that on screen. So what constitutes a contribution? Part of that definition states that contributions are voluntary and non-reciprocal. This is in stark contrast to an exchange transaction, what we're used to in a for-profit entity where there is commensurate value being exchanged. Think when you go to the store, you give somebody money equal to the value of, or what you feel is a reasonable value for the good or service that you're getting in return. So there's an exchange of commensurate value. In a contribution, that doesn't exist. There is no return being provided for the donation that's being given to the nonprofit organization. Another important factor is contributions are not investment by owners. Unlike, again, a for-profit entity, where an owner may infuse an organization with cash, along with this expectation that they're going to be repaid, either through future profits or as receiving a percentage of ownership of that business or entity. Again, nothing is being returned to the individual providing this donation. Now, we talked about exchange transactions, where commensurate value is being exchanged. The one thing to keep note is that immaterial benefits don't constitute an exchange transaction. We often see this in nonprofit entities where an organization or business will provide a sponsorship, which is a type of contribution, in exchange for a very immaterial item in return. Quite often it's logo placement at an event or possibly in printed materials. But this immaterial exchange does not constitute any form of advertising service being received by that donor. And other similar immaterial gifts or benefits are treated just the same way, in which they are a contribution, not an exchange transaction. Now, this is one of my most favorite parts of contribution accounting, and it's donor intent. And why donor intent really matters is because donor intent has the ability to create what we call donor restrictions. When a donor places some sort of restriction on the gift, it must be used per the stipulations placed on by the donor. And there's no ifs, ands, or buts about that. The board can't make that change. Management can't make that change. The Almighty themselves can't make that change. The donor is the only person who has the right to change any of the restrictions that they've created on their gift. And restrictions come in quite a few ways. They can be time-specific, purpose-driven, or perpetual in nature. Now, quite often, donors will provide explicit information on their stipulations in the form of donor letters, or very simply memos on check lines. But sometimes donor intent can be a little gray, especially in the case of a memo written on a check line where not a lot of information is available. And so it's important for organizations to utilize communication with their donors to truly understand if any restrictions actually exist and to ensure they have the right restriction understood. Something like a donor letter being sent to say, "Thank you for your charitable gift funding the renovation of our new building," can actually go a long ways to clarify with the donor and confirm that that is in fact what they were donating for. For example, that donor may have actually meant to give you $100,000 to provide ecological support because the expansion of your building was expected to displace, various little animals and things in the region. And so, again, it's important to make sure that you confirm the restriction with the donors to make sure that you can actually fulfill their wishes as well. If you're an organization that specializes in helping, elderly veterans, you're going to have a hard time fulfilling a donor wish that says that they want you to support at risk young children. So again, it's important to understand your donor's restrictions and stipulations very clearly to prevent yourself from getting in hot water. And one of the most important things to note is that a contribution by any other name is still a contribution. Much like many things in accounting, it's important to understand and to really read about the substance over the form. Most agreements will have something in it that you'll be able to read and understand and truly be able to identify, what is this agreement actually? Is this a contract where each party is receiving commensurate value and potentially an exchange transaction? Or is it truly a non-reciprocal transaction and thus a contribution accounting? Are there any conditions? Are there any restrictions? A lot of these things are really important to assess in the actual agreement itself, not simply looking at the name of if it's called a contract, a gift, an award, a grant. Quite often, what we see, especially in the grant world, is a large government organization will come to a nonprofit entity and say, and work with them to provide some sort of service. That government entity will come and provide a $500,000 grant to help with homelessness in the Los Angeles region. And sometimes individual or organizations will mistake that to think that they're being hired by the government agency as a subcontractor, and that in fact that is a exchange transaction, when in reality the FASB actually states that the greater good of society at large does not create an exchange transaction. There is not commensurate value being received by that government agency because you're helping the organizations at large. And so again, that just points to the fact that it's important to understand your agreements more than look at what the name of the organization of the agreement is. And it's not either or. These agreements can have aspects of them that are exchange transactions and grants and contributions, I should say. And it's important to parse them out and to treat them appropriately depending on what is appropriate for each parts of those agreements.